Hello gentlemen, we're on page 323 of your textbook. We're going to look at the generally accepted accounting practices, and they lead to accrued and prepaid expenses. So there are 6 principles. The entity rule you should know from EMS, that the financial affairs of the owner and that of the business should be separate. Historical cost concept you also dealt with now. It is the basis of why we do the depreciation calculation. Going concern means that a business must be foreseen to continue in the foreseeable future. Then the next one is the matching concept. That is the one that is quite important for the next section of the work. So that means all income and expenses must be accounted for the correct time period, meaning that for my financial period or my financial year, that all incomes that was earned during that time must be included, and all expenses that were incurred must also be included, whether I have received the money or not, or whether I have paid the money or not. So it's important you'll see the difference between the income and the receipt, and the expense and the payment. It's quite important. Prudence means that financial results should be drawn up, and they should reflect a conservative approach. Quite simply put, that if there are 2 methods of calculating the value of something, for example, that you take the more conservative approach. Materiality then, it's also that material items must be shown in the financial statements. So obviously changes that you made or things that have a massive impact must be shown, but immaterial items need not to be highlighted. For example, interest on overdraft must be shown in a specific account, because if you're on an overdraft, then you owe money to the bank, you've gone over your limit, while something like consumables can be included with sundry expenses, like you do not keep track of the tea and the coffee in your office. Okay, so then moving on to the first one is the year-end adjustments, or there's quite a few year-end adjustments, that because of the matching principles, okay, matching concept, income and expenses are matched to the correct financial period. So you've dealt with depreciation. We're going to deal with accrued expenses and prepaid expenses now. We'll look at income received in advance and accrued income in the next lesson, on the next recording. We're going to look at trading stock deficit and consumable stores on hand. These are all adjustments that you do at the end of your financial year. So moving on to the accrued expenses. Accrued expenses are expenses that are still owed by the business at the end of the financial year. So, because you have the matching concept, these expenses were incurred in your current financial year, they must be included in your current financial year. You do this by an adjustment at the end of the year, and this goes in the general journal. Remember that with journals, that unless it's for something specific, like CPJs for cash payments, and DJs for debtors journal, and the CAJs for credit allowance. So there's no specific journal for adjustments, so it goes in the general journal. A relevant expense account will increase because my expense for that specific item needs to be increased. So an expense decreases owner's equity on the debit side, so we will debit the expense again. For every debit there's a credit, so the credit here is accrued expenses. It's a liability because the business still needs to pay that amount, so it owes that amount, so it's a liability. So accrued expenses, look at the example now. The water, electricity was paid, 4532, but there was an account received, it had not been paid. This is an example that you'll get quite a few times moving forward. Accounts was received but not yet paid. Water, electricity, telephone, advertising, whatever it might be, you can receive an account that is not yet paid. Okay, so the adjustment. So water and electricity must increase by that amount. So the expense increasing on the debit side, 435. For the debit, there's a credit. Accrued expenses, 435, because I still owe the municipality the water and electricity. So the total expense, so 4532, then you add the 435, 4967. Even though I have only paid 4532, my expense for the year is 4967. So remember about earlier that the difference between expenses and payments, it's hopefully starting to become clearer now. Prepaid expenses are expenses then This is the opposite, where they've already paid for the expense in the next financial year, in the current financial year. So a good example would be a lot of people, before they leave on a December holiday, they pay their insurance 2 months in advance. Or what people do is they pay every 3 months, but there might only be for something. You pay quarterly, but your financial year is only 1 or 2 months of that quarter left. So you've paid in advance for the next year. So applying the principle of matching, then these prepaid expenses must be excluded from the current financial year. This is done by adjustment in the GJ. The relevant expense account will decrease because that section of the prepaid expense is only relating to the next year. So the expense, which is normally on the debit side, must therefore decrease. If you decrease the expense on the credit side, for every credit there's a debit. The debit here is prepaid expenses. It's an asset because you've already paid them. For example, let's say it was insurance, so they already have your premium. So they must still then give you the service. They must still insure you for that month. They still owe you that service. So they owe that to you. Anything that is owed to the business is a asset. So look at this example. So this is the one you'll get quite very often. So you have an expense of 3,600 for advertising. However, this includes 400 Rand that for the 2 months in the next financial year. So you'll have quite a few variations on that, but most importantly, draw a timeline that shows the start of your financial year, the end of your financial year, and then you can also allocate, because sometimes you pay 3 months, sometimes you pay a year in advance. If you draw your timeline, it's quite clear to see what should be included, what should be excluded. Okay, so your adjustment, the advertising must be less with 400 Rand. So how do you decrease advertising? By crediting advertising, because it's an expense. That's the credit. The debit, prepaid expenses. So the total expense for my current financial year is 3,200. So going back to the matching principle, even though I paid 3,600 to my advertiser, only 3,200 is for the current financial year. So this is your pre-adjustment trial balance on the last day of the year. So you're going to adjust the accounts now. You're going to say, okay, telephone, up till this stage I've paid 2,761, and insurance I've paid 6,600. But we must now adjust or update these amounts. Why? Because if you apply the GAAP, the Generally Accepted Accounting Practice Principles, it must be the most up-to-date information. So the telephone account has been received but not yet paid, and insurance includes an annual premium. So if you say something is annually paid, it's paid for the next year. There are 12 months in the year, so we'll work out now how much of that year is in the current financial period. So telephone must increase by 227 because I've received the telephone bill but I haven't paid it yet. So debit, and then the credit is accrued expenses because I owe Telkom 227 Rand. Now look at the calculation for prepaid insurance. The gentlemen, this is very important, but we'll practice this in the future. So that 960 was for a year. So 7 months is in my next financial year. So only 5 months in the current financial year. So my prepaid expense is 560. So the better way to see this is insurance, which is an expense, must decrease by 560 because 560 is only in the next financial year. So in the next financial year, prepaid expenses is an asset, 560. So we will make sure that you draw your timeline because that helps you determine if you have to do the allocation of the months. You know, it's 7 months has been paid in advance. It's a prepaid expense. So now we go to the general ledger. Telephone debit balance because it's an expense. Insurance debit balance because it's an expense. Okay, telephone is increasing, 227 on the debit side, and the credit is accrued expenses. Insurance is decreasing on the credit side. Prepaid expense is an asset, 560. So my amount that I take to profit and loss for telephone, which is my actual telephone expense for the year, is more. It's 2988. Well, insurance, it's a smaller amount because 560 is only relating to the next financial year. So owner's equity and liabilities, the accounting equation. So telephone is an expense that is increased, so an expense that decreases owner's equity, and I owe Telkom that, so that's a liability, create a liability, while the prepaid expense is an asset, so that goes in the asset column, the owner's equity, so an expense that is decreasing, so an expense initially decreases owner's equity, and an expense that decreases, so it's almost like in mathematics, if you multiply a minus by a minus, you get a positive. So just remember that whenever you see an expense that decreases, it's not the expense that decreases the owner's equity, it is the actual expense that decreases. So just make sure you know what to look out for. Thank you, gentlemen.